Hi everyone, my name's Ken Green. I'm a Forex trader and co-founder at BitSilk Investments. And today I'm going to talk through the macro side of our pitch for Sandstorm Gold. In order not to make any cheap mistakes in our trading or investing, we need to know our industry like the back of our hand, which is why I'll start with an overview of what is the mining industry, how does it work, and who are the key players. After this, we'll look at the more juicy stuff, such as the key drivers and where they're heading. Then we'll move on to a Porter's analysis of the royalty streaming industry, explaining the five forces and where they're heading. Finally, we'll wrap up by combining the macro viewpoint and the streaming industry viewpoint, which will provide the direction of trade which Sean's micro or company-specific analysis will build on. So what is the mining industry? In short, the mining industry is a branch of manufacture and trade based on the extraction of commodities. This does not include refinement under the standard industrial classification. This industry is huge. Any physical production will involve the usage of commodities. The industry employs 672,000 people in the US alone and amounts for 624 billion US dollars of output. So how does it work? Well, you have your three typical activities. Firstly, there's production. These are your miners and smelters, for instance, involved in extracting the ores from the ground. Then you have your trading, which is part of a business for all miners. Once they mine the gold, they have to trade it to a refinery, and then once it's refined, it can then be traded on an open market. Finally, there's investing. So for example, many miners will keep reserves in order to smooth revenues and also to sell at a future date if commodity prices are increasing. Let's narrow down a bit now and focus on gold mining. So who are the key players? Well, you have your five different types of company here, namely exploration, development, producers, royalty streamers, and prospect generators. Firstly, exploration miners search for new deposits of precious metals. However, this is very risky because the probability of a mineralized body becoming a mine is about 1 in 3,000. Next is the development stage miners, which are involved in the planning and constructing of a mine. So this is after they've done the trenching and geophysics and they've identified that there are resources here. This is less risky than explorers because they are in the next stage of the mining cycle. Okay, next we have the producers, and these guys actually operate the mines. The resources and infrastructure has all been identified and built, and now they can start extracting. This is much less risky than your junior companies, aka exploration and development stage. However, they do hold some operational risk. And then you have your creme de la creme, the royalty streamers. These companies provide a facilitating role where they provide capital to mining companies in exchange for a royalty contract or streaming contract. So you have your two basic forms of royalty contracts, and that's your NSR or net smelter royalties, and the other kind is NPI royalties. NSR is the right to receive a certain percentage of revenue directly from the smelter, and that's Sandstorm's favorite type of royalty because you take out the issues of how much does it cost to mine the gold. On the other hand is the NPI royalty or net profits interest, and that's where the royalty holder gets a certain percentage of the profit from the mining company. Finally, a stream provides the right to purchase a certain percentage of production directly from the mine at a discounted price. So it might be something like 2% of lifetime production at 30% of the spot price. And that's fantastic because that means that the streamer will always have a 70% profit margin on that gold. The key benefit for gold miners is streaming companies provide an alternative form of capital, and mining is a capital intensive business, so they always need it. They're always in need of capital. Given that's the most efficient and safest part of a gold equities business, streaming is ironically the least leveraged, which is to say that when we're in a real gold bull market, the later stages of the gold bull market, ironically, the royalty companies underperform. But in the early stages of a gold equities bull market, which is what we're coming into, the large royalty and streaming companies are the primary beneficiaries of flows from generalist investors who are normally more financial types. So from an investor perspective, last year, gold producing companies were averaging 13 or 14% margins. As an investor, you would be happy to pay a lot more for a streamer or more likely to invest in a streamer with a 70% margin business and a low cost of capital than you would for a 14% margin business with a higher cost of capital. Finally, and these are exploration companies that search for areas with high potential for significant discovery. Once the prospect generators get to the high cost point of exploration development, they will joint venture with companies that have money to spend. This makes them less risky but also reduces their reward, as the joint venture partner will take a hefty earning on the project. Out of the above types of companies, I recommend avoiding investing in exploration development and prospect generators. That's because these companies are much more of a roll the dice and see where they land play. Less than 0.1% of prospected sites will lead to a productive mine, and only 10% of global gold deposits contain enough gold to justify further development. So unless you have inside information that one of these exploration companies has hit the jackpot before the news breaks out, there's really no reason to subject yourself to these high-risk companies. Whereas there's plenty of upside, dividends, steady cash flow, and leverage to the gold price within the producers and royalty streamers. Before we look at the key drivers, it's best we first understand the characteristics of gold. Firstly, gold is scarce. There is a capped amount of gold we can extract from the earth. Peak gold is the date at which the maximum rate of gold extraction is reached, and we might be approaching that date soon. Peak discovery of new deposits was reached in 1995, and we've been on a decline, quite a dramatic decline since then, with record lows in terms of new discoveries recently. Next, there's gold's uniformity, and this refers to the characteristics of being a commodity. 24-karat gold bar in China is the exact same as a 24-karat gold bar in Canada. Finally, there's gold's resiliency. So in terms of chemistry, gold is a very unreactive metal, and that means it doesn't wither away or lose value in itself. These three physical characteristics build up or enable its market characteristics, which firstly is its use as a currency, which dates back to 550 BC. Gold's three key physical characteristics, alongside its malleability, made it a natural trading medium. Nowadays, its most important function is a hedge against systemic risk in the monetary system. In the last 100 years, we've had 4 changes in the international monetary system. These things aren't as static as you might think. However, one thing that is tried and true is gold. And that's not to say that the gold standard is better or should replace a fiat system, but rather gold could at least present some part of a solution or settle the scores if the incumbent monetary system goes wrong. And we'll explore these ideas further later. So the most important driver for the gold mining industry is, of course, gold. The higher the spot price, the larger the difference between revenues and costs, and therefore higher profit. And this then sets the tone for future investment in production. Other drivers include the price of oil, because this makes up to 40% of production costs. You have to think about how these mines operate. They're usually in the middle of nowhere. You don't have to sidestep a gold mine on the way to Tesco's. They're usually in unpopulated areas, which means a lot of expenses are used on transport costs. The next driver is technology, and this reduces production costs. So it's very important. However, it's very slow moving, and that's because if a brilliant new piece of equipment comes out, it's not necessarily going to be implemented straight away. And that's because the incumbent infrastructure being used is expensive and likely has more productive capacity left. Now we're going to look at the most important driver now, which is the price of gold. Gold is a safe haven asset, and therefore confidence matters. When social trust in fiat currency and sovereign bonds is tested, gold will do very well. As mentioned earlier, this hedges against the current monetary system. A nice way to treat gold is like an insurance plan against financial disaster, and it's important to distinguish this as real insurance against systemic issues, unlike the sort you would buy from an insurance company. This is because in a systemic crisis, everyone who has bought insurance is owed insurance, and an insurance company cannot pay them. That's not how the business model works, which is why systemic risks such as nuclear explosion, war, and hurricane are usually excluded. And by the way, what do these insurance companies do with the money that's collected until it's time to pay insurance? Well, they invest in stocks and bonds. So it's this completely circular idea where the insurers themselves are tied in with a systemic risk. Next, there's inflation. So if real rates on equities, bonds, and real estate are negative, investors will flock to gold as an asset that will maintain its value. And then there's war and political crises, which have always sent gold higher. And again, it's this idea of hedging against the worst case scenario. The current macro climate is the perfect storm for gold. And because there's a lot of moving parts here, I've laid everything out on a mind map so you can see how it fits together. So first of all, let's look at this systemic risk. And that's shown its face in the repo madness we had last year in September, where the repo market, the repurchase agreement market, where banks and various leverage strategy hedge funds finance their operations, there was a breakdown in that market and rates shot to 10%. The Fed came in with what it said was temporary operations, something like 30 billion a week, and that was supposed to be for a few weeks. But the bottom line is that never stopped, and it continued throughout the rest of 2019. So it reminds me a lot of 2007. So if we have a look at this chart here, in the summer of 07, two Bear Stearns hedge funds blew up. And this is when the subprime CDO started collapsing. Of course, most people attribute the crisis to the fall of Lehman Brothers, but this was, of course, preceded by the collapse of Bear Stearns, which was bailed out by the Fed. And people thought the systemic financial risk was off the table, which, of course, it was not. And here we are today, where once this virus emergency started, these Fed operations increased exponentially to $1 trillion a day. So this systemic risk never went away. And the similarities between the problem in the repo markets and the subprime CDS is they're both this obscure part of the market where no one really knows what's going on. Applying this to gold, you have an increase in systemic risk, which is bullish for gold. And then you have the QE. And what this does is the base for existing currency units. So if you print 2, 4, 10 trillion of new liquidity unbacked, that devalues the existing currency in circulation. So that's directly bullish for the gold price as you have more dollars chasing the same amount of gold. Next, we have the big elephant in the room, and that's the debt bubble. So let's start with a sovereign debt bubble. The on-balance sheet liabilities, this is the US government's liabilities to bondholders, now exceeds $23 trillion. More importantly are probably the off-balance sheet liabilities. These are promises made to certain elements of society, particularly older people. And the estimate for this by the Congressional Budget Office exceeds $120 trillion. So what's the policy response to this? Well, the USA services this with their national income, and that's taxes and fees, less expenditures. But the problem with that is the national income this year will be in a $2 trillion deficit. So that's not a valid solution. The only other options are default, which is highly unlikely for political reasons, or debasing the currency enough to inflate away the net present value of these obligations. So the currency is like this release valve. If you buy all the bonds with new money, then the currency will take the slack because all of that investor money in the US, if there's no bond market, they're going to go abroad. And all that money washes out the US system, collapsing the currency. Either way, this compromises confidence in the US dollar and treasuries and therefore bolsters demand for gold. At the same time, we have the US corporate debt bubble, and US corporate debt to GDP is at an all-time record high. This can trigger what Raoul Pal, a famous macro strategist, refers to as the doom loop. To summarize, this is where the BBB corporate debt space, much of that debt is downgraded to junk, and this can be caused by the economic downturn factor over here. There won't be enough buyers of this junk debt. A lot of pension funds have rules restricting them to buy it. So they'll have to sell all of their downgraded bonds and take big losses, causing the market to freeze. So if you're old and your pension starts tumbling, where would you go? Well, you might decide I've had enough of this malarkey and buy some gold. So that's another driver there. Next, we have US dollar problems. So finally, there's this problem of the US dollar being the world reserve currency. And this is where Brent Johnson's dollar milkshake theory comes into play. And essentially, this describes a strong dollar causing havoc within the dollar-denominated debt space, in particular, emerging markets debt, which is mostly denominated in dollars. So as the dollar goes up, these interest payments become more expensive. And if these EM countries default, then the supply curve of dollars shifts to the left. Remember, if we're issuing debt, that expands the money supply. So withdrawing it does the opposite. And this immediate withdrawal of dollars crashes supply more than demand. So this further increases the value of the dollar for other countries, and it becomes this positive feedback loop where the dollar gets stronger and stronger, eating up all the other currencies and eventually eating itself. Now, this is exactly what happened in the 1930s, where the dollar got too strong and they had to unpeg it from gold and devalue it by 40%. So in the case of, so even in this case where the dollar is increasing in value, and that's usually bearish for gold because of their inverse relationship, but the havoc the strong dollar will cause will lead to a flight to safety to assets such as gold. And then on the flip side of this, if the US dollar does get devalued, that's also good for gold. Next, there's political instability. So there's geopolitical conflicts in the Middle East, the India and Pakistan borders, and also the North and South Korea borders. We also have trade tensions. So Trump's been going all guns blazing on trade, taking on China and the EU. And this instability is favorable for gold. Next, there's the deflation story. And this is the thing the Fed fears the most. It's the thing they've been fighting for the last 20 years, a debt deflation. And what we currently have is a slowdown in the business cycle, followed by trade wars, followed by an oil crisis, and then followed by COVID. And that makes the probability extremely high that we're going to get a big debt deflation. So bond yields look like they're going negative. And that means bond investors are pricing CPI inflation to go massively negative. That means that real yields adjusted for inflation are going to be going up and not down. And that's the real problem here, is when real yields go up, you destroy the economy. And that's when the Fed have always feared that they might run out of bond yield and then CPI goes negative. And although they said they wouldn't go to negative interest rates, in order to combat this, the policy response, one of the only options they may have is to take interest rates negative. Next is the tech deflation. So Jeff Booth, the writer of Price of Tomorrow, is an expert on deflation. And he says secular deflationary trends will be the ultimate undoing of monetary policy, and that technology is the driving this deflation at ever increasing rates. He talks about how technology is deflationary and how it's not a guess but a fact. So when you think about computing power doubling every 18 months and the cost reductions this has, and the only thing that's been stopping this deflation has been the extreme QE over the past years. And the reason why banks have been doing so much QE is when you have this much debt in the world, if you have a deflation with too much debt in the world, you get that negative spiral we talked about earlier. And Jeff thinks that the central banks won't be able to hold this forever. And eventually we will get this big deflationary event. However, during this event, confidence in the current system will fall, and this will cause gold to go up, even if you have the value of other assets going down. So next is the supply of gold. And we had peak discoveries in 1995, and we're also coming out of one of the longest gold bear markets, so 2011 till 2019, and where there's been a big underinvestment in exploration and development. So when the price of gold picks up, the demand is going to dwarf the supply. Okay, on the flip side of that, we have demand for gold. So the current market share of precious metals in saving and investment instruments in the US is around 0.33 to 0.5%. This is in contrast to at the peak of the gold bull market in 1981, where it sat at around 7%. The most important stat here, though, is the 3-decade mean in that period was 1.5%. So if we just have a reversion to the mean in demand, that will mean an increase in demand for gold between 300 and 400%. But that's just the individual investor side. What about the central bank side? Well, China, Russia, and India they all have the most gold resources ever, their central banks, and they've been buying steadily over the past 2 years. So we've talked about the deflationary environment, but what about the other case scenario, which could be an inflationary environment? And that's something we've talked about quite a bit, which is where this QE money debases the currency and causes inflation. Richard Werner talks about this in his book Prince of the Yen, and he describes how essentially when new money creation is used for productive means, it's not problematic because with the increase in money supply, you have an increase in output. However, the trouble is today, most of this money creation is going to non-productive means, and that's going to cause monetary debasement and inflation, where more money is chasing the same amount of goods, and that's inherently bullish for gold and commodities, which are scarce. Finally, there's this factor of the economic downturn, and we talked about the potential for weak cash flow causing insolvencies. If there is an economic downturn, for reasons mentioned throughout this presentation, gold is counter-cyclical, so that's good for gold. And we've talked about QE, but the other policy response has been artificially low interest rates. The interest is, of course, the return you get for taking on the credit risk of, for example, a 10-year treasury. And as we've described, due to these risks here, that credit risk has now increased. At the same time that the risk has increased, the reward for a coupon has decreased. So forget about risk-free risk. This is return-free risk. And this is the principal adversary for gold to compete against. In the traditional safe haven space, you can make the case that Bitcoin is its rival in other ways. And all the central banks have said that they are in a lower for longer scenario. Empirical evidence shown by Richard Werner actually shows that interest rates lag the economic cycles rather than lead them. So if we are indeed heading into an economic downturn, we can expect a lower for longer scenario to be the case. So these policy responses, artificially low interest rates and QE, are both rocket fuel for gold, and soon after gold equities such as Sandstorm. So just to give some context here, here's the Barron's Gold Mining Index, a collection of gold mining equities. So we're down here, and as you can see, there's huge upside from the oversold bottoms. The index has increased between 180% on the low side and 1,200% on the high side in periods of time as short as 13 months and up to 42 months, which is really incredible returns. And of course, if you choose one of the better stocks in the index, you would have even higher returns. A very common feature of these commodity markets is they have this explosive momentum towards the end of their rallies, and that's met with an equally dramatic sell-off. So the key lesson here is to get in early, and we see this bottoming structure forming over here. So it makes a lot of sense from a risk-reward perspective to get in now. Now we'll move on to the Porter's 5 forces. So competition in this industry is moderate to high. They provide a commoditized service, so they must compete on efficiency of contract terms. The threat of new entrants is low, as it takes huge capital and high expertise to be successful in this game. And the power of suppliers is low. There's plenty of miners, so they have very little individual leverage over the investors. Power of buyers is high, the royalty streamers can pick and choose because the miners always need capital. And the threat of substitutes is moderate. The miner could take a loan instead, but the conditions may not be as favorable. We should also add the other points that the streaming industry is a lower risk. It has a lower risk profile than other subsectors, and also the high propensity of the raw streamers to lead first within the gold equity bull market. So to wrap up, because of all the drivers in this mind map, I firmly believe we're about to see an extensive rally in gold, and soon after gold equities, and Sandstorm being a royalty streamer will be in the basket of the first stocks to do so. Within the mining industry itself, we see that the Porter's conditions for streamers are particularly favorable. So the combination of this and the bullish gold perspectives provides a beautiful environment to invest in royalty streamers. I will now hand it over to Sean, who will explain why out of these streamers, Sandstorm Gold presents the most golden opportunity.